Hello and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's go watch the analysis.
February 12th, 2026. The ticker is EQIX, Equinix. At the opening bell, the stock gaps up, surging 10.42% to close at $957.87. But the price is only half the story. The volume, that tells the real tale. 2.69 million shares traded. That is nearly 4 times the daily average volume. As of yesterday, February 17th, we have seen stabilization above that $940 level, closing specifically at $951.97.
The numbers are undeniable. I mean, you can't argue with them, but the narrative behind them is what we really need to stress test today. That February 12 move was the single largest percentage increase for Equinix in, over a decade. The central question for every allocator listening is pretty simple. Is this price action a rational re-rating of the company based on a structural change in the AI landscape, or are we witnessing a classic overreaction to forward guidance that is actually masking a technical revenue miss and some very serious, very expensive capital risks?
It is absolutely a re-rating, and frankly, it's a long overdue one. What the market finally digested last week is a structural shift we're calling the inversion of inference. For the last 3 years, the entire AI narrative has been about centralized training, building these massive AI factories in the middle of nowhere to train models like GPT-6 or Gemini Ultra. That phase is maturing. Now the pendulum is swinging. The workloads are migrating to the network edge, where Equinix completely dominates. This isn't just about renting space anymore. Equinix is transitioning from a digital landlord to let's call it the orchestrator of a global AI brain. The price action reflects the market realizing that Equinix is the primary beneficiary of this next phase.
Orchestrator of a global AI brain is a beautiful phrase, I'll give you that. But let's look at the plumbing before we get carried away with the poetry. The market is effectively ignoring some pretty significant red flags here. You have a company that just missed its Q4 revenue consensus. You have a stock that is technically overbought relative to every major historical moving average. And perhaps most concerning, right into this surge, you have significant insider selling, including from the CFO. To me, this looks like a liquidity event that smart money is using to exit, not an entry point for a long-term hold.
I appreciate the skepticism. It keeps us honest. But you're looking at the rearview mirror while the market is pricing in the windshield. Throughout late 2025, Equinix was just stuck in a long-term consolidation. Investors were paralyzed by fears over interest rates and CapEx. What shattered that ceiling on February 12 was a 2026 guidance. And we aren't talking about incremental growth here. Management projected revenue of $10.1 to $10.2 billion. That is 10 to 11% top-line growth.
Guidance is just a promise, not a payment. We've seen plenty of tech companies guide to the moon and deliver a crater.
But look at the margins. Adjusted EBITDA margins are expanding to 51%. That is a 200 basis point improvement over 2025. That demonstrates operating leverage that the bears said just wasn't possible in a high CapEx environment. The inversion of inference means that as AI models become agentic, capable of reasoning and acting independently, they need to live closer to the user and the data to reduce latency. That is Equinix's turf. This forecast was a blockbuster. It justifies the premium because it proves the business model scales even as the technology itself shifts.
I'm not disputing that the guidance looked good on paper, but I feel compelled to ground us in the actual realized performance. You mentioned the windshield, but the car just hit a speed bump. In Q4 2025, Equinix reported revenue of $2.42 billion. The consensus was $2.46 billion. They missed. In a market that's priced for perfection, a miss is a miss.
It was a technical miss based on timing. You know how lumpy these revenue recognitions can be?
Timing of non-recurring installation fees was the official excuse. That's the oldest trick in the REIT playbook, To me, that often sounds like a convenient way to mask a slowdown in deal closures. If customers are delaying installations, that's a signal of hesitation. But let's look beyond the earnings print.
Let's look at the behavior of the people running the company. On February 12th, the very day the stock popped 10%, CFO Keith Taylor sold $1.9 million worth of stock. This is a man who is retiring this year. He knows the books better than anyone. If the future is so bright, why is the guy with the checkbook cashing out into the rally?
Look, Keith Taylor still holds over 24,000 shares. A retirement-related sale is, well, it's hardly a vote of no confidence. It's estate planning. You can't fault a man for diversifying as he exits the workforce. He has been there for decades.
It wasn't just him, though. The chief people officer, Brandy Galvin-Morandi, she sold as well. And if we zoom out to institutional flows, JP Morgan reduced their stake by 23.72% in Q4. That is a massive exit by a major player right before this supposed inflection point. I'm suggesting that the smart money saw the overbought status and the capital intensity required to hit those 2026 targets, and they decided to take chips off the table. JP Morgan doesn't generally hate making money. If they sold, they saw a ceiling.
You're cherry-picking the flows to suit the bearish narrative. You mentioned JP Morgan, but you're completely ignoring the super investors who are doubling down. Cohen & Steers, arguably the premier real estate investment shop in the world, they increased their stake by 23.31%. Citadel Advisors increased their position by 147% in late 2025. These are sophisticated funds that understand real assets and volatility. They aren't scared of the CapEx because they see the booking velocity. And that brings me to our core disagreement, the quality of demand. You mentioned the revenue miss. I'm telling you the leading indicators are flashing green.
Okay, let's dig into that green flash. You're hanging your hat on future bookings to explain away a current revenue miss. That's risky.
I'm doing it because the bookings are historic. In Q4, annualized gross bookings hit a record $474 million. That's up 42% year over year. You can't fake that kind of demand. And here is the crucial detail that the bears are missing. 60% of the large deals in that quarter were AI-driven. But, and this is the key, 50% of those AI deals were not from the hyperscalers like Amazon or Google. They were from traditional enterprises. We're talking about finance, healthcare, manufacturing companies, building private AI clusters.
Walk me through that. Why does a bank need Equinix for AI? Why not just use AWS?
Data sovereignty and latency. A bank running a proprietary trading algorithm or fraud detection model. They simply cannot afford the latency of sending data back to a centralized cloud, nor do they want their sensitive data training a public model. They need private AI, so they rent a cage at Equinix, put their own NVIDIA DGX boxes in it, and connect directly to the cloud via Equinix Fabric only when they need to. That is the retail colocation model, selling smaller chunks of power at much higher margins than wholesale. That is why the bookings are up 42%.
That sounds impressive, but is it sustainable? This reliance on, this narrative around agentic AI and enterprise adoption is still in its infancy. You're asking investors to pay a premium today for a technology adoption curve that might be a lot slower than the hype suggests. If those non-recurring installation fees that cause the miss are a sign that enterprises are hesitant to deploy capital, perhaps waiting to see if these AI agents actually work, that 42% jump might be a peak, not a baseline. We saw this with the cloud migration back in 2018. Adoption happens in waves, not a straight line up.
The evidence suggests this wave is different. The guidance for 2026 AFFO per share adjusted funds from operations, the gold standard for REIT cash flow, is growing 9 to 12%. Stifel and TD Cowen called this a meaningful step up. The demand isn't just theoretical. It's showing up in the pre-sales. Management revealed they already booked over $100 million in pre-sales for Q1 2026 as of mid-February. I mean, that is the strongest start to a year in company history.
Okay, but I want to pivot to what they are actually selling, because you called them an orchestrator earlier. At the end of the day, Equinix is a real estate investment trust. It rents concrete boxes with power and cooling. It's a landlord. But the valuation suggests it's a software company. It's trading at a multiple that implies zero friction, which just isn't true for physical assets.
That is the fundamental misconception. Equinix is no longer just a REIT.
I should say, it's a technology platform. In late 2025, they unveiled their distributed AI infrastructure. But the real game changer launching this quarter, Q1 2026, is Fabric Intelligence.
Fabric Intelligence. It sounds like marketing fluff, something designed to sort of justify a higher multiple. What does it actually do?
It is far from fluff. Think of it as a software layer that allows the data center to act as a dynamic brain. It uses something called the Model Context Protocol, or MCP. This allows AI agents to interact directly with the Equinix Fabric API. We are moving toward a world where a network autonomously adjusts using natural language intents. A customer can literally tell the network, optimize for lowest latency to London for the next 4 hours. And the system adapts routing automatically. No engineers, no tickets. That is why they command a premium over a standard box provider. They are selling automation, not just floor space.
But does that automation layer justify the valuation gap compared to Digital Realty? Let's look at DLR. They have a massive $1.4 billion backlog. They win on sheer scale. If I'm a hyperscaler needing 50 megawatts for a massive training run, I'm going to Digital Realty. Equinix trades at a normalized PE of almost 65x. Digital Realty is expensive too, but the premium Equinix commands, it requires flawless execution. I'm not convinced that Fabric Intelligence, which is essentially a smart routing API, is enough of a moat to prevent Digital Realty from eating their lunch on the large-scale AI training deployments.
But we aren't talking about training anymore. That's the whole point. We are talking about inference. That's the inversion. And there is a physical constraint that favors Equinix here: power. Digital Realty is building these massive 100-megawatt factories. Those face incredible power bottlenecks. It's getting harder and harder to get that much juice from the grid in one spot. Utilities are pushing back. Equinix's distributed edge model uses smaller power envelopes across more locations. It's more resilient and just easier to power. It's easier to find 5 megawatts in 20 cities than 100 megawatts in one.
Easier to power, perhaps, but incredibly expensive to build and operate. And this brings us to the build bolder strategy. Equinix aims to double its total data center capacity by 2029. We are talking about 52 major projects in 36 countries. They are pouring $3.9 billion into the UK alone. They're building in Madrid, Lisbon, Lagos. In a high interest rate environment, and rates are not going back to zero, this level of capital intensity is dangerous.
It's necessary ambition. If you don't build the capacity, you lose the market share.
It's a cash flow bleed. They are forecasting huge capex. And you have an activist investor, Elliott Management, involved in the stock. Historically, Elliott hates unchecked spending. They want operational efficiency. They want SG&A down to 15%. I suspect Elliott is looking at this build bolder plan with a lot of skepticism. If the AI demand softens even slightly, Equinix is left with massive, expensive capacity and a balance sheet weighed down by construction costs. I mean, digging holes in Lagos and Lisbon introduces geopolitical risk, currency risk, and execution risk.
Actually, I think Elliott and the other super investors see the sustainability moves as a de-risking factor. Equinix isn't just building blindly. They're innovating on energy to solve the very grid constraint you mentioned. They signed advanced nuclear deals in early 2026. They are exporting heat to homes in Helsinki. This long-term thinking creates a defensive moat against regulation. And regarding the CapEx, Cohen and Steers increasing their stake by 23% tells me that the best real estate analysts in the world believe the operating leverage will outpace the costs. They see that margin expansion to 51% and realize the spending is efficient. They are building into a vacuum of supply.
Or they are chasing momentum. Let's not forget that J.P. Morgan, one of the most sophisticated banks in the world, sold a quarter of their position. And the technicals back them up. The stock is overbought, the RSI, the Relative Strength Index, is stretched. When you have a company priced for perfection, priced as the sovereign AI backbone, any slip-up, like another technical revenue miss in Q1, could send the stock tumbling right back down to the $800 level where it spent most of January.
The downside protection is just, it's gone at these levels.
But the guidance for Q1 is already strong. They're projecting $2.49 to $2.53 billion, a 4% sequential increase, and they have a $20 million tailwind from foreign currency. The momentum is real.
Currency benefits are fleeting. If the dollar strengthens, that tailwind becomes a headwind. The core business needs to justify a near $1,000 stock price.
And it does. The partnership with NVIDIA, showcased at GTC 2026, positions Equinix as the physical home where these AI networks converge. They were the first to host the Blackwell-powered DXG superpods. Salesforce is using Equinix Fabric for their Data 360 engine. These aren't just tenants, they are deeply integrated partners. The stickiness is why the recurring revenue grew 9.7%, even when the top line missed slightly. Once a company integrates their private AI into the Equinix Fabric using Fabric Intelligence, they aren't leaving. The switching costs are just too high.
Stickiness is good, but valuation matters. I'm looking at the risk-reward. You have a stock that jumped 10% in a single day. You have insiders selling into that strength. You have a massive build-out plan that requires perfect execution in a complex global energy market. While the AI story is compelling, I fear the price today leaves absolutely no room for error. If the agentic AI revolution takes 2 years longer than expected, Equinix is holding the bag on some very expensive infrastructure.
And I see a company that has successfully pivoted. The inversion of inference is a multi-year tailwind. We are in the very early innings of enterprise AI, and Equinix is the only player with the global footprint and the software layer, Fabric Intelligence, to facilitate it. That is why the stock stabilized above $940. The market knows this isn't a fluke. They are betting on the infrastructure that makes AI usable, not just the chips that make it smart.
We will see if the dynamic brain can outsmart the balance sheet realities of doubling capacity in 3 years. History is littered with infrastructure plays that got ahead of their skis.
A fair challenge. We have laid out the bull case for the structural shift and the bear case for the capital risks.
Indeed. Whether Fabric Intelligence justifies a 10% premium is now up to you to decide.
If you like this video and want to watch more content like this, then subscribe to the channel. Thanks for watching. See ya.